Hi everyone, welcome to our channel 4334. Today, let's walk with us through the topic, do stockholders discipline US banks? Banks earn profit by borrowing money from depositors at low interest and invest in high return businesses. However, during crisis, depositors are anxious to get their money back, so they rush to the banks to withdraw the money. At the same time, as businesses do not perform well and cannot repay their loans, banks has insufficient capital to return to its depositors. So it is important that banks hold enough capital so that it can reassure depositors during crisis. However, bank managers would not want to hold a lot of capital because banks can finance their business using leverage and earn high profit. This improves returns to equity for shareholders, which is an important KPI for firms in general. In this case, government steps in to monitor banks according to the Basel framework. As financial markets become increasingly complex, regulators want to share the responsibility of monitoring banks with the markets. We're interested in studying the market discipline aspect of Basel II. So how does market discipline work? As banks have to publicly release their quarterly financial statements to depositors, bondholders, and shareholders, these market agents can use this information in their decision-making and move the market forces, in turn disciplining banks of high-risk level. For example, ideally, depositors should deposit less in risky banks. Bondholders and shareholders should ask for a higher premium when bank stocks are more risky. For the bond market, Morgan and Sterol shows that market discipline is strong in the bond market. That is, bond spreads increase for riskier banks. However, economists believe that market discipline fails, at least for depositors. In 2008, depositors were found to deposit in risky banks since they know the government will bail them out anyway. This is called the too big to fail phenomenon, especially when risky banks offer high interest returns. There isn't a large body of work in market discipline for banks in the stock market, which is why we want to study to test whether stockholders do indeed discipline poorly capitalized banks. In our model, this can be measured by order imbalance, when the more people buy rather than sell bank stocks, or risk premium when shareholders ask for high returns from a poorly capitalized bank. We want to see how the market discipline changes with conditions in the market, using the bull market before financial crisis, the financial crisis, and the government bailouts at 3 periods of interest. Just as bond spread increases for riskier banks, we intend to find out if risk premium increases for poorly capitalized banks. However, since returns do not show the full price of the story, we want to look at other measurements such as order imbalance. We intend to use the intraday epoxies for order imbalance using CRSP data to show investors' preference for bank stocks based on capital adequacy of banks. We can study how this preference changes in varying market conditions. Intraday order imbalance from trade and quote or TAQ can also be considered if we have the luxury of time. So why is this topic important? A paper by Flannery explains that if stockholders discipline poorly capitalized banks using price signals, it forces bank managers to behave in a more responsible way. But if they don't, and on the contrary reward risk-taking behavior during economic booms, it can encourage managers to take excessive risks. For example, in 2008, risky banks continued to take excessive risks in what is termed gambling for resurrection. This is at taxpayers' expense. After the collapse of Lehman Brothers, the Federal Reserve intervened by buying troubled assets of banks and raising the upper limits of deposit insurance. So in summary, we expect that during recession, the market discipline is present since investors are more risk-averse. Thus, investors will be less willing to buy stocks of poorly capitalized banks and ask for excess risk premium. During the bull market before recession, investors may be less concerned with risk. After recession, it remains to be seen if government bailouts do weaken market discipline. Thank you.